What's up everyone, it's Scotty with Money Vesting. In this video, I wanted to talk a little bit about how you can make sure that you are safe when it comes to banking. So in this video, my goal is to pretty much go over this very simple yet might be boring presentation of asset protection and allocation. So I'm going to go over and I'll actually share a lot of resources down in the comment section. So I will actually pin my own comment with a lot of resources that might benefit you when you are thinking about, how you can actually protect your assets. And this is more in terms of like banking and cash and securities and all that stuff. And I'll be going over what are some of the things that we need to be paying attention to. Well, because let's face it, right? Bank failures, although rare, they do happen. And they've happened a lot since 2001. You'll notice that, over 157 bank failures in 2009. If you look at 2008, we had over 25 banks failed. 2010, 157. That's including all small, medium, regional banks, larger banks, all included. And then, of course, in 2023, the reason why I'm actually doing this video is because even Silicon Valley Bank, the 16th largest, 20th largest, depending on different metrics, also failed and caused a lot of mess in the financial sector, right? And financial institutions. So my goal in this video is to get you a little bit more aware and get our understanding up a little bit when it comes to FDIC insurance, SIPC insurance, what's covered, how the coverage limits work, and what are some of the other options out there that we can take advantage of when we are kind of spreading our cash, spreading our savings, right? Because it's our hard-earned money. And the worst thing would be to just simply lose it because one bank was not careful about their deposits, right? So that would absolutely be very, very unfortunate. So hopefully in this video, I can help at least one person get their finances a little bit better in terms of safety and better allocation. So hope you guys enjoyed this video and find it helpful. If you do, make sure that you drop a like and don't forget to subscribe to the channel as well. So let's just talk a little bit about what FDIC is, okay? And I can tell you right now, it's going to be a bit of a boring video because I had to kind of read through a lot of fine print. I've taken a lot of screenshots. I've kind of put all that together, but hey, if you want to be safe, if you want to understand these things, it is going to be reading those fine print things that, people don't necessarily read. So hopefully this video will kind of break that down. And there's going to be a lot of visuals as well. So don't worry, I'll keep it interesting. So FDIC is pretty much short for Federal Deposit Insurance Corporation. And you may have already heard of this. And if you are, creating a new bank account, if you are starting with a new bank, chances are most of the banks in the United States are members of the FDIC. FDIC is a government agency. And what it does is that it pretty much protects consumers, right? Depositors. It pretty much protects depositors of insured banks located in the United States against the loss of their deposits if an insured bank fails. And the interesting thing is that it doesn't only apply to U.S. citizens or residents. Like for me, for example, I'm in India. I'm a citizen of India. I'm a resident of India, but I do also have a bank account over in the U.S., which I disclose for all tax purposes and everything. So a person does not have to be a U.S. citizen or resident to have his or her deposits insured by the FDIC. That's straight from their website, and that's what they mention, right? So just because you are a U.S. citizen or resident doesn't mean you are the only one who gets insurance from FDIC. Even if people who are not, U.S. citizens or residents, they also are insured by the Federal Deposit Insurance Corporation as being part of having that U.S. bank account and, of course, having funds in that account. We'll talk about coverage limits in just a second. Now, FDIC insurance is backed by the full faith and credit of the United States government. And since FDIC began operations in 1934, this line is very careful. No depositor has ever lost a penny of FDIC insured deposits. Really, really important line there. So no depositor since it began operations since 1934 has ever lost a penny of FDIC insured deposits. You definitely want to be taking advantage of this to the best you can. You want to make sure that you are meeting those coverage limits. You're not going above, because if any amounts are uninsured and if you have excess savings, you want to make sure that you're moving that around in a strategic way and you're being smart about it so you are under that limit, and want to make sure that you are taking advantage of this FDIC insurance. So what does it cover and what does it not cover? Now, FDIC does cover ownership accounts, and there are categorical ownership accounts such as your checkings account, right? So current account, checking account that you're using on a day-to-day basis. You've got your savings account here. You've got your money market deposit accounts, time deposits such as CDs, so certificate of deposits, and cashier's check, money orders, and other official items issued by the bank, and your negotiable order of withdrawal accounts as well. So those are some of the things that they do cover. And this could also include like joint accounts with your spouse and your agent or whatever it is, your business partner. If you got a joint account, they're also covered. but we will be talking about the insurance limits and how they're kind of categorized. Now, what does FDIC not cover? Okay, it's your stock investments, right? So if you're investing in the markets, of course, that's not going to be covered. If you're investing in bonds, not going to be covered. Mutual funds, life insurance policies, annuities, municipal securities, safe deposit boxes, or their contents, and U.S. Treasury bills and bonds or notes. But there's an asterisk here because they mentioned that, of course, the U.S. Treasury bills and bonds and notes are pretty much backed by the full faith and credit of the U.S. government. So you are pretty much getting that safety as well because, again, U.S. Treasuries are considered to be risk-free because they're backed by the U.S. government and at the full faith and credit of the United States government as well. So who covers these things right here, right? So if FDIC does not cover stock investments, bond investments, mutual funds, all that stuff, which organization covers it? Well, that is going to be your SIPC. That's going to be the Securities Investor Protection Corporation. It's a little bit different than FDIC, but FDIC covers your basic checkings account, savings account, your time deposits like CDs and your basic money market funds. And then when it comes to investments, SIPC is the insurance company. However, you have to understand that these organizations don't insure funds for market losses, but they only insure in the case of a bank or a brokerage fails. Right? So what we saw with Silicon Valley pretty much collapsing and failing on kind of meeting up with expectations of depositors, in those events, in the rare event the bank fails, that's where these insurance companies kind of step in to help depositors, right? Not because you made a bad investment and of course the prices of your stocks or bonds is collapsing. Obviously insurance policies are not going to be kicking in then, but it's mostly if there's a bank failure or a brokerage failure. So according to FDIC, the standard deposit insurance amount is $250,000 per depositor per insured bank for each account ownership category. And I explained what that means later in the video. And then for Securities Investor Protection Corporation, so SIPC, also protects customers if their brokerage firm fails. Again, it's a very, very important to understand if a brokerage firm or a bank fails, that's when FDIC or SIPC kind of kicks in with their insurance coverage. If it happens, SIPC protects the securities and cash in your brokerage account up to $500,000, and the $500,000 protection includes up to $250,000 protection for cash in your account to buy securities. So SIPC limits are a little bit higher than FDIC. FDIC pretty much protects $250,000 per depositor per insured bank per each account ownership category for $250,000, and SIPC is going to be $500,000, but of that $500,000, $250,000 is only for cash in your account, and $250,000 is going to be for securities. Now, what conditions apply? So let's just go over what SIPC protects and what it doesn't protect, just like we did for FDIC. So SIPC protects your brokerage firm, and you have to make sure that your brokerage firm is a member of SIPC, so is a member of Securities and of course Securities Investor Protection Corporation. So there's a list. There's a whole list where you can actually online check it out. I'll leave the resource down in the comment section below, but you can go to that list. You can search for the brokerage that you're using, and if they are part of that list, then of course they are protected with SIPC. And you have securities at your brokerage firm, and you have cash at your brokerage firm to buy securities. So those are the three pretty much things that they protect. So they have to be a member of SIPC, and then securities and cash in your brokerage account is protected by SIPC. Now, SIPC does not protect your investments if the firm is not an SIPC member. So again, different jurisdictions are going to have different insurance corporation. This is strictly for the US, so that list is most likely going to be for the US that you can find. But if you are watching this video and you're in Europe and you're using a different brokerage, I'm sure there's going to be an insurance corporation that oversees brokerage firms over there. So all you have to do is kind of do more research in the brokerage firm that you're using, and all you have to do is just look up, okay, which insurance corporation kind of oversees on a more national basis, which insurance company basically oversees all these brokerages and what are the limits, right? So the general idea is going to be the same. Obviously, every single person, I can't, specifically go into every jurisdiction, but all you have to do is do more research and see, which, insurance corporations kind of oversee, both on the FDIC basis and of course on a securities basis as well. So both on a banking basis and on a brokerage basis. So SIPC, as I said, does not protect against market losses. That is really, really important to understand, right? And promises of investment performance or commodities or future contracts are not things that SIPC pretty much insures. Now, another thing that I want to talk about is that just because you have a bank, right, and it is FDIC insured, you can still have some type of risk, systemic risk, if obviously the bank has failure. You'll still be protected by FDIC, no problem there. But if you can, you may want to look into something called a systemically important financial institution, or called SIFI in short. These are also called GSIBs. These are systemically important banks. They're also kind of interchangeably used. And these are banks that, there's been some research and there's been reports according to the Basel III study and the Basel Committee of Banking Supervision, so BCBS. And there's also been a study from the Financial Stability Board, FSB. And they have pretty much put together a list of banks or financial institutions who, if failed, right, if those banks actually fail, they might trigger a financial crisis, right? So they're colloquially referred to as too big to fail. So there's a list of banks out there that pretty much are considered as too big to fail. There was even a movie about this after the Great Financial Crisis. And the bottom line is that if these banks end up in that situation, the chances of the government stepping in are dramatically higher than if you are banking with a company or banking with a bank that is not on this list, right? Even if the bank is not on this list of SIFI, or if it's not considered as a systemically important bank, but it has FDIC insurance, you're fine, right? It doesn't have to be a big problem. It's not really a challenge. But if you can, definitely look into some of these systemically important financial institutions, because chances of the government stepping in, if there is financial failure or bank failing, are dramatically higher. So this is going to be the 2022 list of globally systemically important banks, or GSIBs, as I mentioned earlier. And this is put together in conjunction with both the Financial Stability Board and the Basel Committee on Banking Supervision, so BCBS. And this is the list right here. So it might be a little bit too small. I'm going to zoom in. So we've got JP Morgan, of course. JP Morgan, one of the largest banks in the United States and in the world. We got Bank of America. We got Citigroup. We got HSBC. We got Bank of China, Barclays, BNP Paribas, Deutsche Bank, Goldman. We got Mitsubishi, Agriculture Bank of China. We got Bank of New York Mellon, China Construction Bank, Credit Suisse. We got, Credit Agricole, ING, Mizuho, Morgan Stanley, Royal Bank of Canada, so RBC, Santander, Societe Generale, Standard Chartered, State Street, a few other banks over in Canada and Europe. Then we got UBS, UNI Credit, and Wells Fargo as well. So these are considered as, the banks that are systemically important banks, meaning that if they were to somehow have any type of bank failure, there would be, pretty significant financial crisis, right? If you think about it, of course, God forbid, if something were to happen to Bank of America or JP Morgan, we would be in a much, much worse situation. We'd have much bigger problems than just kind of making sure our funds are safe. So again, the probability of the government stepping in for these GSIBs is much higher, and for them to get a bailout is much higher than compared to anything that's not on the list. But again, even if it's not on the list, if you find a bank that you're banking with right now, it's not on the list, again, no need to panic, because they are FDIC insured. In most cases, you definitely want to check with that as well. But if they are, there's really no need to panic here. And that's just a list that I wanted to go over and really break that down for you. Now, where to actually put money, right? Where you can actually store, or pretty much, put your savings and put my hard-earned savings if I were to kind of spread that out, right? So one thing we already know is banks, FDIC insurance. You definitely want to be paying attention to that. SIPC is for securities accounts only. So if you are investing in stocks and options and bonds and whatnot, you want to make sure that you are investing with a broker that is member of the SIPC. And again, depending on jurisdiction, you may want to do some more research and which actually brokerages have insurances where. But another place to look into is, of course, certificate of deposits, CDs, right? CDs actually are very, very popular. And again, this is only for if you have savings, right? If you have cash on the sideline. For example, if I have cash sitting on the sidelines and I'm not ready to invest and I just want to simply save that money, and there's this, fear about, what if banks were to kind of fail in the future, right? There's always this fear. And for my peace of mind, what I want to do is, and I'll go over the solutions later in the video, I really want to make sure that I have all the options covered, right? So CDs is one of the options. CDs can be a very useful tool for saving towards long-term goals or potentially earning a higher interest rather than you would with savings account. And if you use CDs as part of your saving strategy, it's possible to use them to work around the FDIC insurance limits through CDARS. That's what it's called. These are Certificate of Deposits Account Registry Service. And they also have a network of banks that insure millions for CD savers. So you definitely want to be taking advantage of that as well. So there's a whole network. Again, I'll leave some resources down below for you to check out and do more research on them. But the way it works is simply, once you actually have a CD, let's just say, for example, that you sign a CDARS placement agreement and custodial agreement, then invest money with a CDARS network member, right? That's a bank or it's a member who is part of the CDARS. And this money is then divided into CDs issued by different banks. So theoretically, you could invest $5 million with CDARS and have it split into multiple CDs, each of which would be protected by the $250,000 FDIC insurance limit. Kind of think of it kind of like a sweep where you're putting in, close to, let's say, a couple $1 million, and it's getting split between a lot of FDIC insured banks through CDs, and you're protected across the board on all of your accounts, right? So all savings are under that limit. Another option out there is credit unions, right? Something that I've personally used before. I used to have the DCU, that's the Digital Credit Union, if I'm not mistaken. I forgot what the name was when I was in the US. Definitely had a credit union, which is going to be paying you a little bit of a higher interest because credit union definitely want to attract more business. And you definitely want to make sure that they are part of the National Credit Union Administration, NCUA, because most credit unions are not insured by FDIC, right? Most of the banks are, but credit unions aren't. So credit unions have a different insurance overseeing authority, which is the National Credit Union Administration, NCUA. So as it says here, while credit unions are not covered by FDIC insurance protections, they are still protected. The National Credit Union Administration insures deposits of up to $250,000 per depositor per credit union for each ownership category. And you can use the NCUA's share insurance estimator to determine how much your deposits would be covered. So that's another option out there. So here are some of the solutions that I wanted to put together for us, for all of you, and for myself as well. And solutions are that I want to make sure that I am banking with systemically important banks who have FDIC insurance, right? So banks that are on the important list. So for example, I'll give you an example. I personally have right now Bank of America, right? That's on the list, systemically important bank, and it's FDIC insured. So that's number one. Number two, I make sure that I spread my deposits into multiple owner categories and SIBs. So in other words, I have multiple bank accounts, right? So different banks that I have accounts with, that each of them separately will have a $250,000 insurance limit under FDIC, right? That's another way to make sure that you are protected with FDIC insurance. Number three, I make sure that I have CDs through CDAR network banks. So again, if you are taking the CD route, certificate of deposit, I'm making sure that, if I do take that route, the network member that I'm investing with or kind of storing my cash with is a member of the CDARS, because that's also a very, very important sort of authority there. And if I'm investing in, let's say, credit unions, I want to make sure that they are also members of NCUA because they're not insured by FDIC. And NCUA is, again, going to be the National Credit Union Authority Administration. So you want to make sure that they are part of that, so you're getting that insurance limit as well. Number four is going to be, I make sure that I invest in U.S. Treasuries, right? U.S. Treasuries, I didn't go over that in too much detail because it is very self-explanatory. Because it's backed by the U.S. government, full faith and credit of the U.S. government, of course, it's considered risk-free. So there's absolutely no doubt that I would not be receiving my principal back. So that is an option out there for having that liquid cash available. And in future videos, I will be talking about bond ladders. And that's something that I am planning to actually do starting maybe later this year, where I will be building out 3-month, basically 13-week, 17-week, and 26 weeks bond ladders. And what it does is that pretty much is going to be some amount set forth for these T-bills, which I will be buying with different maturities and different sort of yields, right? So what it does is kind of keeps cash flow going. We'll explain what that is in my future videos, but bond ladders definitely be taking advantage of that, considering how yields are higher. And of course, you can get a lot of safety if you are just simply putting cash away, which is not being invested right now. And finally, number 6 is going to be, I make sure I use brokers who are SIPC insured. So when it comes to investing with brokers and you are investing in securities and stocks and options and whatnot, I'm using brokers that are SIPC insured. So that's also covered under that. And then bottom line is, read the fine print if you can, and definitely make sure that your insurance limits are, that you understand your insurance limits, what your coverage limits are, and no account is over $250,000. In some cases, it can be as much as $500,000, of course, SIPC. CDs you can invest, and it's going to be split between multiple different accounts in the future, but you want to make sure that you are understanding your coverage limits and you're kind of on top of it, right? Because it's your hard-earned money. The last thing you want to do is kind of leave it up to, one bank or two banks, and, they pretty much, God forbid something happens, as what we just went through with Silicon Valley Bank, and all your hard-earned savings are gone, right? So that's not what you want, right? So you want to be making sure that you're on top of it. And of course, if nothing works, there's one solution out there that doesn't require any paperwork. That's gonna be pretty much putting it under the mattress. Of course, I'm just kidding. So, definitely take advantage of these insurances that are available. But yeah, there's always been this, historical notion that, you can just put it under the mattress and forget about it. But of course, then your money also doesn't grow at all. And it's going to be losing its purchasing power over time due to inflation. So bottom line is that, banks, make sure they are FDIC insured. And if you can, look for SIBs, systemically important banks. When you're looking at brokers, make sure that they come under the umbrella of SIPC. That's your Securities Investor Protection Corporation. When you're looking at CDs, make sure that they come under the CDARS authorization. When you're looking at bonds, whether corporate, government, make sure that the rating's good, AAA. So whether it's the United States, Singapore, Switzerland, Australia, whatever country, whatever, bonds you're looking at, or even companies for that matter, make sure that you're investing in high quality bonds, that are backed by, the best organizations out there, because, there's risk with bonds too. There's risk with everything, there's no risk-free investment in the world unless, of course, you're putting it under the mattress, but even then you're losing purchasing power. So there's risk with everything out there. It's just that degree of risk varies with, of course, stocks versus, banks versus, U.S. treasuries. There's going to be different degree of risks. So keeping that in mind, when you're investing in bonds, if you are investing in bonds, make sure that comes under the umbrella of AAA bonds, whether it's the U.S. government, whether it's, Apple, whatever it is, you're investing in high quality bonds only, because yes, high yields can be very attractive, but then, you're going to be doing that at the risk of investing in triple C's and double B's and triple B's, like really, really crappy bonds, so to speak. And then if you are investing in credit unions, make sure that they're under the umbrella of the National Credit Union Administration, because they're not insured by the FDIC. So you want to make sure that you are getting the benefit of that. And then also make sure the bottom line, the per account, it's less than $250,000, except CDs and bonds and certain accounts that you actually hold in your account. So yes, it's going to be a little bit of a strategic plan, but that's really how, everything functions. So hope you guys got a little bit of value out of this video. Hope you enjoyed this video. Let me know your thoughts down in the comment section below. If I missed anything, let me know in the comment section. Let me know how you are strategizing your asset allocation and your protection strategies as well, so that, we can get this conversation started, and hopefully other members can benefit from your perspective as well. So let me know in the comment section below. What do you think? As always, make sure that you drop a like, subscribe to the channel, and happy investing, and I'll see you all in the next video.